Hello traders, welcome back to new video in our exciting series. I am Sanjay from Thrive International and I am thrilled to continue this journey with you. Thrive Hub, where financial empowerment begins. This session is powered by Thrive Hub, a place for all financial education, an initiative by Thrive to empower traders with knowledge, tools, and community support to excel in the financial markets. Have you ever wondered why some trades seem perfect on the chart but failed miserably when you switch to another time frame? This is where understanding time frame analysis and mastering multi-time frame analysis can revolutionize your trading game. Today's video topic is in continuation with the first video we have made in this series, and it's more focused on technical analysis and chart reading in detail. Very practical and useful to identify correct trade setups by combining multiple time frames. So let's get started. Video part 1. We will dive into what are time frames and how it can help you improve trading strategies. What is time frame analysis? So, time frame analysis is the process of studying price movement within specific time intervals on a chart. Each time frame represents the duration of time it takes to form one candlestick on the chart. So here you will find the different time frames on your trading platform. Then there are multiple time frames available for you to see that what price action is going on in each and every time frame. For example, a 1 day time frame shows price action for whole day, and a 5-minute chart shows price action for every 5-minute interval. Why time frame analysis matters? Different traders have different goals and risk capacity, which influence their choice of time frame. It helps trader align their strategy with their personality and trading style. For example, a scalper focusing on rapid short-term trades will use 1 minute or 5-minute chart to capture small price movement, where a positioned trader uses weekly or monthly chart to capture large long-term trends. A note on time frames. A time frame is a period of time where price movement take place. This is 15-minute chart, and this shows that open price will be at the beginning of the first minute. Means that whatever candle you see, each candle's open price will be on the first minute of the time interval. Let's say this is 15-minute chart. So first minute will be the opening price, and whatever high price happens during these 15 minutes will be the highest price marked on this particular candle, and in 15-minute duration whatever the lowest price traded will be marked as low price on the chart, and at the end of that 15-minute period the closing price will be marked on the last second of this 15-minute period. Alright, so this is how each candle is forming for 15 minutes. Whereas if you look at 1 day chart, then the opening price will be at the opening of the session, and the closing price will, whatever the price has closed at the end of the session, will be taken as closing price. And a higher time frame will always gonna have higher significance. Let's say if you are looking 5-minute chart and you are seeing an uptrend, and on the other hand you are seeing 1 day chart and there is also a uptrend going on. So which trend have higher significance? Of course, the daily chart. Whatever higher time frame you are looking will have higher significance and will result in significant trading signals on that particular time frame. 5-minute trend can diminish too early, but the daily time frame trend can last several days. So that is why the higher time frame will have greater significance. If you are looking at weekly chart, then it will have more significance than the daily chart. And different time frames have different degrees of trend. Let's say 1-minute chart is going on the up movement, and the 5-minute chart is also showing as an up move. But if you look at daily chart and its trend is down, then you can say that the smaller time frames are moving in a uptrend as of now, but the higher time frame have a downtrend going on, and those lower time frames uptrend is just a pullback in the major downtrend. So you need to be aware of what kind of trend is going on different time frames. So that is why you need to analyze multiple time frames to draw a rational conclusion out of it. Without looking at multiple time frames, you might be taking entries in the wrong direction, and trend is our friend. So we always need to make sure that we are trading in the right direction of the trend. We are moving with the market, not against it. The relationship between time frames and trading goals. Your trading goals and style dictates the time frame you should focus on. Choosing the right time frame ensures that your strategy aligns with your risk tolerance, patience level, and desired frequency of trade. Let's break it down. So first is trade frequency. Lower time frame means more trade, higher time frame means fewer trade, because lower time frame have multiple trends going on. So this is 5-minute chart and it is moving like this on an uptrend. Alright, so it have multiple trends. This is up leg and this is a small downtrend, or you can say a pullback, again a uptrend, then a pullback, then a uptrend. So it have multiple trends going on. But if you look at day chart, then it will gonna show you just few candles moving on the upside only. It will have only one trend. So that is why these points can give you multiple entry and exit points on lower time frames, but the day chart will gonna have only one opportunity available at a time. So lower time frames are suitable for high frequency traders like scalpers and day traders. These traders aim to capitalize on small price movement multiple times a day. Let's say for example a scalper may execute 20-30 trades in one day. Each of the trade will gonna last for few minutes. And on the other hand, if we talk about higher time frame, then that will gonna be best for swing traders where they are using 4-hour, daily or weekly charts, who prefer few trades with longer durations because they are focusing on capturing larger price movements over days or weeks or even months. For example, a swing trader might execute one trade per week, holding it for several days. So that is why the trade frequency depends on the time frame you are using. And the second is risk to reward ratio. Lower time frame focus on smaller price moves, we know that, with small stop losses. But on the other hand, higher time frames aims for larger trends with a bigger stop loss. In lower time frame, the advantage is that your risk will be smaller due to smaller stop losses. But the challenge is you need very high accuracy, as smaller stop loss can get easily hit by the market noise. And for higher time frame players, a wider stop loss, a bigger stop loss are more reliable and less prone to intraday noise, or they will gonna get hit very less frequently. Third is market noise. Lower time frames often have more noise, making it harder to identify clear trends. So lower time frame contains more market noise due to random price fluctuations and high frequency trading activity. This is ideal for traders comfortable making quick decision in volatile environment, and of course that will gonna need a very high experience to deal with such kind of decision making very rapidly. But the higher time frame have clear picture of overall trend by filtering out the noise, and it is suitable for traders who rely on big picture analysis rather than micro level details, and it will gonna eliminate all of the noise for that particular player because his stop loss is bigger and his target levels are also far away, so he have a lot of time to make rational decisions by analyzing the situation. Trading goals dictates time frames. So short term goals, if you have short term goals, then you have to focus on lower time frames. It will gonna prioritize quick trades with smaller targets. But if your goal is for medium term to long term, then you have to focus on higher time frames. They will gonna aim for larger price moves in line with overall trend. Alright, so let's see which time frame to use. So there are multiple time frames in your trading platform, and which one will gonna be suitable for you. We have made some points that will gonna help you choose your right time frame. The choice of time frame for trading depends on your trading style and goals. So first of all, we need to pick trading style first. So there are many type of trading styles like intraday trading, where you buy or sell the currency pairs in one single day only. Means you are not holding anything for the next trading day. You are closing your position in one day only. And the second type is swing trading, whereas you are holding it for few days. Let's say you have initiated a trade on Tuesday, then you might exit that particular trade on Friday or Thursday something by holding it few days and capturing swings in the market. And next one is positional trading. Positional trading where you are holding it for months. Means you are having a view that this particular currency can offer you 10%, 12%, 15% moves, then you are holding it for a medium term cycle in the economy. And the next is investing, where you are holding it for years of duration. You have a growth mindset there. And the last one is scalping, which is high frequency trading, where you might initiate a trade for 1 minute, 2 minutes only. Means you are closing your trade very fastly. You are capturing micro movements in the market like 20 pips, 10 pips. This is what you are aiming for. And in this type of trading, your lot size will gonna be much more bigger, and it will gonna need a very good infrastructure to execute trades very fastly. So first, intraday trading, where we buy or sell in the same trading day, focusing on very short term movements, and you can initiate multiple trades in one single day. So you can use 5 minute, 15 minute or 30 minute time frame to trade in intraday trading setups. Your logic might be from 1 day chart or 8 hour chart or 4 hour chart, but to execute these trades you are using lower time frames like 5 minutes, 2 minutes, 15 minutes, something like that. Alright, next is swing trading. Focus on very short term to medium term movement, and traders will try to capture swings in the market. So there are swings forming in the trend, uptrend, and the holding period will be from some days to some weeks. And the time frame you need to use in swing trading will be 2 hours, 4 hours, 8 hours, or even 1 day chart can be used in swing trading. But in Forex, 4 hours and 8 hours will be the preferred time frame for swing traders. And next is positional type of trading, where the plan is to buy and hold. It have a growth perspective, and the holding period will be from few months to few years, and they don't only rely on technical, they combine fundamental analysis too, and the time frame they are using is mostly weekly and monthly time frame, because these time frames offers the major trend in the market and reduce all of the intraday noises from it. So that is why positional player will only focus on major direction of trends. And the last one is scalping. These style have ultra short term trades, and the quantity used by traders will be very high, and they execute these trades very quickly, and the quantity is very high, as we have discussed earlier also. Holding period is microsecond to couple of minutes, and the time frame they are using is 1 minute to 5 minute time frame will be maximum used by scalpers, because they are targeting very small price movements in the market. In the last, you need to be flexible, because trading is an art and you need to make logical decision according to the situation. You need to be this much flexible to change your time frame according to the situation, whatever the market is offering you. Sometimes you cannot see a particular pattern clearly on 4-hour charts, but if you switch to 2-hour chart, then the structure will gonna start to make sense, and the graphical representation is much more clearer. So this is how you can switch into time frames according to the situation and to the pattern that is forming on a particular chart. So till now we have talked about what is time frame and which time frame you need to use in general according to your trading style. Now in video part 2, we will gonna understand trends across time frame and how you can use multiple time frames to get high probability trading setups. So understanding trends across time frame. Trends are backbone of any trading strategy. However, trends can appear different depending on the time frame you are analyzing. What seems like a strong uptrend on day chart may look choppy or even like a downtrend on a lower time frame like 15-minute chart, and vice versa. This is why it is essential to understand trend across time frame to make informed trading decision. And to understand it, we need to know about fractal nature of the markets. So in this section, we will cover top-down analysis of multiple time frames. So first of all, we need to understand what are fractals in the market. So market moves in fractal nature, which is, in easy words, patterns within patterns. If you see this snowflake, this is a microscopic view of a snowflake. Okay, so if we just try to understand it, then it will be like patterns forming within similar pattern. This is the major pattern of this particular structure. In this structure, there are microstructures forming. So the microstructure is this leg here. These are multiple similar patterns forming inside one big pattern. Alright, so we have identified two patterns, and if you look at these single points, then this is similar to this bigger trend, this bigger structure, and inside these smaller leaves will have same structure of this overall structure. So fractal is a complex and self-repeating geometric pattern that exhibits similar shapes or structure at different scales or magnifications. You see, this fractal nature is widely seen in many things, like you can see this plant showing that this degree is one bigger structure, and inside it this pattern is repeating on different scales, and this is going on and on and on. So each pattern is similar in shape but on a different size or scale, right? So this is what fractal nature is. You can see this leaf example also. This is the overall structure, and this similar structure is for this one leaf also. And if you look at the multiple structures like this, then they also have similar structure, but the magnifications or the scale is changing only. The shape will always gonna be similar. So in chart also these fractals are present, but you need to identify it on different time frames, different scales. Fractals are just smaller things that combines to create bigger things. Each of the smaller thing is identical in shape to a larger thing. This is what similarly going on technical charts also. There is also trends within trends going on. We will see it in detail in the next slides. What is multi-timeframe analysis? Multi-timeframe analysis is the process of combining different periods in the financial market before you make a trading decision. Before you initiate a trade, you take time to look at how the charts look like in most timelines. Doing this can help you in several ways. It can help you identify the overall flow of the particular currency pair, and it will gonna help you identify key levels of support and resistance on multiple time frames, so you know that what are the barriers for the price to move. Let's see what are the example of using multiple time frames. First is, it can give you micro view of larger time frames that confirm the trader's original analysis of trade. For example, you have identified a pattern on hourly chart, and you can use 5-minute chart to confirm the entry points and exit points for your trade logic based on 1-hour chart. Next is, it can help you manage the risk effectively by combining time frames. A trader can learn to move stop loss on smaller time frames for patterns that completes on larger time frames, and these smaller time frames can helps you place trailing stop losses effectively, because swings are forming initially on lower time frame and then moving on to the larger time frame. And the third one is using multiple time frames from large to smaller time frames can helps the trader to be aware of contrary or opposing patterns that form on smaller time frames first, that are going against the long-term time frame trend. And of course, it can give you high probability trading setups. So how trends differ across time frames? So let's see it with a good illustration. First is, this is line chart view. So if we are seeing an uptrend, then on the line chart you will gonna see this line as an uptrend, okay, in the form of line only. Then if you just move towards one lower time frame, let's say this first line chart view is on monthly chart, and if you shift on the weekly chart, then it will gonna give you a view like this, a zigzag structure going on. On higher time frame it was just a single line like this, but if you just look one time frame lower, then it is showing you multiple trends inside one single line. So we have an uptrend, a pullback, then again uptrend, then pullback, then uptrend. So this uptrend is going on in waves like structure. Then same price movement on candle chart view. So it will gonna be like this. This one single line will gonna look like 3 candles in a row on candlestick chart. But if you look the same trend on the lower time frame, it will gonna be looking like this zigzag structure. So 3 candles up and 2 candles for pullback, and this continues for each leg. So now you have a general idea that how these trends look like on various time frames. Let's see with an example in detail. that how many entries and opportunities are available on multiple time frames in one single trend. So this is a monthly chart where you can see this up move going on. This is just 7 to 8 candles moving up, but if you see this trend, the box is marked for this particular uptrend, and we will gonna focus on this box move only in the upcoming discussion. So if you look at these one single uptrend on the weekly chart, then it will gonna show you this structure where it have multiple pullbacks and up moves, multiple pullbacks and up move, and it have now very much noise here, but it is very clear, a clear cut uptrend on monthly chart, but it begins to be a little bit choppy when you shift to weekly chart. Let's see what it looks like on daily chart. So here you will see that this downtrend is very big and extended downtrend. You can make entries on this short and you can make entries on this long here. Okay, then a up move, decent up move, then a small consolidation range, then again it moves to the upside, right? And it formed a tight narrow range, gave a breakout, a long breakout setup, then it failed down towards this support line, and then again reversed towards the up move. So you can see how much zigzag and multiple opportunities are happening on the lower time frames in comparison to the monthly chart. So now this was a downtrend, then a uptrend, then again a down move, then again a uptrend, a pullback, then again a up move, then again a pullback. Okay, so this is how you can find multiple opportunities. Alright, and fractal nature. Focus on the fractal nature. The structure is similar, but the degrees of the structure is changing. The scale of the structure is changing on each and every time frame. So anyone who is more focused on long-term move, then he will just buy here and forget about this particular trade. He will gonna keep holding it for months. But he is kind of a swing trader. Then if he has initiated a buy entry at this price, then he need to regularly keep track of this market and exit his position around this zone or this zone, because he does not want to lose all of the profits when the market is giving a big pullback here. Alright, so the swing trader needs to close his position at this price, whereas the long-term trader does not worry about this situation. He can just buy and hold, right? So switching into the multiple time frames, you can identify multiple opportunities also. So let's see what it looks like on 1 hour chart and what are the patterns forming. Can we find more opportunities out of this particular chart? So you can see this, there are multiple trends are going on. This is first down move, then a pullback, then again down move, then pullback, then down move. Okay, this is a reversal forming, then again a breakout happening at this level, then move up, second leg up, and then it went into a tight consolidation. So we can initiate a long entry after this consolidation also for a robust momentum move to the upside. Alright, then it started to reverse. It formed swing lows here. It started to form lower highs. It shifted into a tight consolidation around this zone, then again gave a wonderful breakout of this line and then moved up, right? So why it moved up towards this? Because this has some kind of barrier forming. Multiple structures are forming, consolidation, then up move. Okay, leg 1 up, consolidation, and then again rally to the upside. It formed a flag type of a structure here in this pattern. So you can initiate a long move up here, and this is a established resistance area. So if you have took the long entry at this price, then you need to book your profits at this level. Alright, a sharp decline from this resistance, and this is a established support area. So the price started to reverse up here. So you can see how good opportunities are forming on a 1 hour chart in comparison to the monthly chart. So you can rotate your capital multiple times in these wonderful trades on lower time frame. As we have discussed that lower time frame have very high trading signals generating, and on monthly time frame or higher time frame the signals are very less. So this time frame has generated only one buy signal. This has generated three signals, one here, second here, and third one is forming here. Okay, but this daily chart has generated 1, 2, 3, fourth signal, then fifth signal. This reversal is the sixth one. Again this flag breakout, seventh signal. There are multiple signals are forming, and the hourly chart have uncountable signals generating. So the noise is very high. You need to take decisions accordingly. Let's see another example to clear out any confusion forming. Alright, so this is monthly chart. In a downtrend we can see the major trend for this currency pair is down. Alright, and we are focusing on this down leg only. The box move is we are focusing on. So let's see how this reversal has occurred, and will we be able to capitalize on these down moves, this rapid downfall for the 2 months. So if we shift on to the weekly chart, you can see that it has formed this down move, a consolidation type of situation, or it is kind of wedge forming, or if you just more simplify it, then it is just a flag forming up. But here you cannot see any flag. On monthly chart you cannot see any flag because it is not pretty clear to our eyes on these candles. But here it is pretty much clear that downfall and a flag or a wedge is forming, right? And if you look more closely, it has formed this double top structure here, right? If we just shift towards the daily chart, then you can see it has formed a very good range. A horizontal distribution range has been formed in the form of double top here, and it has formed a support area also. So you can easily take entry on the short sell, on the breakdown of this structure, right? And you can easily get this much of down move. 1:3 risk to reward ratio is offered by this structure, right? So yes, you can take entries on this down move, but you need to analyze it on multiple time frames, right? And you can see this reversal forming up here. Can we see it on the monthly chart? No, it is coming out of the blue. But if we look at the daily chart, you will find that it has formed a very good reversal pattern forming up here. See this down move, a pullback, then narrowing down moves, means it has formed a higher low, and then it has narrowed down this downfall, and it has given some move to the upside, right? So nothing is out of the blue. If you are analyzing it correctly by using multiple time frames, then it will become very much clearer. This is 2-hour chart. You can see how it has also offered you good entries, early entries. And this is an advantage of using multiple time frames, that lower time frames give you signal ahead of the larger time frame. If any pattern, a triangle is forming on monthly chart, it will gonna take months or years. But any reversal has been forming on day chart or hourly chart, then it will gonna give you an early indication which can help you take better risk to reward ratio, right? So let's see what is the pattern forming around reversals. So reversal begins on a smaller time frame first, and then slowly moves onto the higher time frames. So you can see this is a monthly time frame and this reversal has occurred. Okay, but you cannot see it clearly on this monthly time frame. You cannot find any structure. But on the other hand, if you look at the weekly time frame, it has formed a very good double top structure and it has given you a good breakdown below the double top neckline. And even if you have not been able to enter at this breakdown, it has given a perfect retest of this breakdown level. So you can take entries around this retest and then you will be able to capture this big down move here, right? So reversals or any kind of structure is forming first on lower time frame and then moving on to the higher time frame. So by analyzing multiple time frames, you get what the market is about to do, right? So there are some rules for multi-time frame entries. First is monthly trend. Establish the main trend, the major trend any currency pair or any asset is forming. So you need to look at the monthly time frame first. Then trade logic can come from any time frame. It can be daily time frame, it can be monthly time frame, it can be weekly time frame, or it can be hourly time frame. But you must go to the lower time frame to find exact entries and exit for that particular trade logic. Alright, and always take entry in the direction of major trend. Major trend means if you are trading on intraday basis, then you need to take your trade on the daily time frame trend. Daily time frame trend is upside, then you need to plan your entries on the long side only. Okay, and if large time frame is not agreeing with the smaller one, it will be better to evaluate the trading signal again. Whatever trade logic you have found out, just evaluate it again, because the larger time frames are not aligning with it, right? So let's discuss about what are some common mistakes to avoid. While analyzing trends across time frame, traders often make errors that can lead to poor decision making and unnecessary losses. So there are some common mistakes you need to avoid. First is ignoring higher time frame trend. So we have discussed it earlier also. Do not trade against the trend. Always trade in the direction of the trend only, and always look at the higher time frame. Next is over analyzing multiple time frames. Many traders, what they do is they try to align each and every time frame in their direction. Like they are trying to align 5 to 8 time frames in one single direction, which is very hard. So what you need to do is you need to stick to 2 to 3 major time frames that will gonna affect your trade and stick to it, and just try to align these time frames, which is higher time frame, medium time frame and lower time frame, which will be your entry and exit time frame, right? And you will be good to go. For example, for a swing trader, use daily trend to identify the trend, and 4-hour chart to identify your trade logic, and 1 hour or 30-minute chart to plan your entries and exits, right? Then reacting to noise on lower time frame. Sometimes overreacting to small price movements or patterns on very lower time frame, mistaking them for significant trend reversal. This is the major problem in many traders, and this is not a technical problem, this is a psychological problem, and this can trigger premature exits or entering trades without fulfilling your entry rules. So to avoid it, you can always cross check lower time frames with higher time frames and look for key support and resistance areas that can have greater significance, right? And using same strategy for all time frames. This is also a big mistake, because single strategy cannot give you good profits on each and every time frame. If a crossover strategy is working good on 1 hour chart, it is not true that it will gonna work similarly on the daily time frame also. there might be some changes required for the day time frame to work effectively. Alright, so use strategies that are working best on a particular time frame. For 5-minute chart, a strategy can be different, and for weekly chart, the strategy for trading can be different. Next is switching time frames mid-trade. It can affect you adversely. So constantly switching time frames during an active trade to check if it is still valid or not, this can lead to emotional decisions such as exiting early or adding to a losing trade. So stick to your planned trade to avoid these kind of emotional decisions, and trust your analysis and avoid second guessing based on lower time frame noise. If you have initiated a trade and you have planned it carefully, then just follow your analysis. Don't make irrational decisions based on the noise forming on lower time frames. Last one is failing to adapt to changing market conditions. You need to be aware of current trends and change in those trends. So the trend can change and you need to adapt accordingly. You need to change some parameters in your strategy also, and you need to adjust your risk to reward ratio also according to changing market conditions. And if you are failing to do that, then you might have a losing trade in your hand. Alright, so you need to be flexible around changing market conditions while using multiple time frames. So I think we have a very good idea of how time frames work and how you can use multiple time frames to get a very good trading opportunities available in the market. This is all for this video. Make sure to subscribe to our community channels to stay updated. Tribe has launched amazing offers for you, so make sure to visit tribe.com for these offers. Thanks for sticking around. If you found this video helpful, there's plenty more to come in our series on Forex and technical analysis. And don't forget, for all your trading needs, visit tribe.com. For in-depth trading education, head over to tribehub.com. Thanks for watching, happy trading, and I'll see you in the next video.